The problem with most agencies is that they're suffering from indigestion, not starvation. They just happen to feel the same, and they often look the same on the numbers and reports that you're looking at to run the business. And so we're going to talk about the difference between indigestion and starvation today and how to identify what the problem is, why it's happening, and exactly what you need to do to break out of the cycle of insolvencies. Welcome to the Agency Profit Podcast, a show dedicated to going deep space on agency operations, which is just as nerdy as it sounds. I'm your host, Marcel Petitpas. I'm the CEO of Parakeeto, a firm that helps digital and creative agencies measure and improve their profitability. Join me as I interview some of the smartest thought leaders and agency owners in our space and go deep into operations, metrics, and all the other things you need to get right so you can spend less time worrying about operations and more time executing on your vision. Hello and welcome back to the Agency Profit Podcast. In today's episode, we're going to be using an excerpt from a talk that I delivered at the All-In Agency Summit, which is an awesome online event hosted by my good friend, Chris Dubois. He does one every year. He's doing another one this year, and I'm speaking at that one too. So we'll leave some information about Chris and about the event in the show notes. But this talk is really about mastering the 3 key levers to managing and improving your profitability as an agency. There are some visuals that accompany this talk, and so I want to encourage you to check out our YouTube channel where you'll be able to watch a video of the talk along with the visuals that I draw as I present. So with that, I want to thank you for tuning in. I hope that you enjoyed the episode.
Marcel, welcome to another summit.
Thank you for having me, Chris. It's a pleasure to be here.
I view Marcel as like the John Nash of agency finances, where like numbers are just like floating everywhere and he knows exactly what to piece out in order to get whatever desired result you're looking for. He is the CEO and co-founder of Parakeeto, who is also a sponsor of the summit. So thank you to the Parakeeto team for spreading word, getting people here. But yeah, when it comes to agency numbers, Marcel is the guy that I turn to for advice. I've literally asked a question before and he replied back with like a whole series of webinars that I could watch to get like a deeper understanding. And I watched them and got way deeper of an understanding. And I'm probably a better agency coach for it. So yeah, without further ado, Marcel, I'm going to give you the floor and and you can use your magic tablet here to wow everyone.
Amazing. Thank you so much, Chris, for having me. It is an honor and a privilege to be here at the All-In Agency Summit. And thank you everyone who's here for taking time out of your busy day. I know just how hard and time consuming it is to run an agency. And so the fact that you're all here taking time out of your day to listen to me, I don't take it for granted. And so my mission in the next 45 minutes is to give you as much as I possibly can and really give you the 20% of information that you need to know to get 80% of the visibility into your agency and how it's running, so you can really start to take control over your profitability and know how to navigate almost any situation that might arise and stay profitable regardless of what's happening in the market, to services, to clients, etc. That is what I want to try to articulate to all of you. And I want to make sure we leave some time for Q&A, because this stuff, we get in the weeds on it. And I want to make sure we leave some time for the details, the nuances. So get your fingers ready. I'm going to be asking you for engagement in the chat. I'm going to be asking for questions. You're going to have an opportunity to ask those. And with that, let's dive in. I'm going to go ahead and share my iPad screen here. So I'm here to talk about agency profitability optimization. And as Chris mentioned, I'm the CEO of a company called Parakeeto, and this is what we do. We help agencies measure and improve their profitability using our proprietary framework and technology, and we combine all of that with coaching and consulting. So we literally take you by the hand, walk you all the way through the process, and then help you run it on an ongoing basis. So you never have to worry about cleaning up messy data in spreadsheets ever again, or making a change to your tools and having it break all of your reporting. We handle all of those things, but that's enough about what we do. The important thing here is, what problem is this going to help you solve? And I want to describe the story that I hear from a lot of founders that we talk to about their experience scaling a service-based business. And I want to know from all of you as I run through this, if this is resonating, let me know in the chat. So the first thing that tends to happen is they start the business and they start to grow. They bring in new clients. They get a bunch of sales wins. Everyone's super excited. Look, the agency's growing. Our top line is going up. It's super fun. And then all of a sudden, the team starts to get overwhelmed because there's all this new work coming in, all these new clients, all these new things that need to get done. The team starts to get slammed. And so leadership steps in and starts to help them kind of get through this crunch, this push that's going on. The leadership team starts to realize, oh shit, we're working in the business, not on the business. We need to step back out. And so we're going to hire some more people to take on this client load, and we're going to be able to zoom out and start building the business again. As they do that, they take their focus off the ball on sales. Their profitability drops as they take on more payroll, and they have to start training these new hires and get them ramped up. Then all of a sudden they lift their head up and go, oh shit, we need more work to get this new team that we built busy again. They go back to selling, they grow the top line revenue of the business, and before they know it, the cycle starts to repeat itself. And what we see time and time again is businesses that double, triple, quadruple over the years. And the founders say, we thought we were going to outgrow these problems, these cash flow and profitability problems, and always kind of feeling like we're behind the 8 ball and our team's overworked. And yet, no matter how big we get, the same problems keep coming back, keep cropping up, just at a larger scale. And in some cases, we've seen this be so bad that founders have, we had one founder, for example, that came to us and said, we've tripled the business in the last 18 months. And as founders, we're taking less money home than we were when our business was a third of the size. How is that possible? How is it possible that we have more revenue, more clients, a larger team than we've ever had before, and we're making less money? It doesn't make any sense. And what's true about most firms, and David unfortunately knows this story all too well. Don't worry, Dave, we're going to talk about how to get out of this cycle. The problem with most agencies is that they're suffering from indigestion, not starvation. They just happen to feel the same, and they often look the same on the numbers and reports that you're looking at to run the business. And so we're going to talk about the difference between indigestion and starvation today, and how to identify what the problem is, why it's happening, and exactly what you need to do to break out of the cycle of insolvency. So if you're ready to learn about this, let me know in the chat if this is exciting. Otherwise, I'm sure you all have lots of emails to go check. You probably could use a snack. So I don't know how Chris would feel about this, but I can give you all the next 58 minutes back, and you can go and do that before the next session if this is not interesting or compelling to you. But if it is, let me know in the chat, and I'll dive in. And while I wait for those responses, if this looks familiar, here are some of the questions that you're probably wondering, right? Why aren't we more profitable? You could look at your profit and loss statement and see that you have money coming in the top, not a whole lot coming out the bottom, and a lot of expenses in the middle. But the question is why? Is it that we're not pricing things high enough? Is it that we are over-servicing clients? Is it that our team's not utilized? Is it that we pay too much for our talent? Is it that our overhead expenses are too high? Or is it a combination of all of those things? And if so, what should be your next priority? That's what we're going to talk about today. The next question is, what does good look like for us? Right? You can go on Google and look up benchmarks and see what, the numbers should look like across these different metrics, but you probably have a very different context than a lot of these other agencies that you're trying to benchmark yourself against. You sell different things to different people. You hire different people. You are in a different geography, right? There are different contexts. And the reality is there isn't just one set of benchmarks that everybody needs to abide by. There are ratios that you should probably try to achieve, but we've audited hundreds of agencies in the years that we've been working in this industry. And I can tell you that there are people that have not matched up to any of the industry benchmarks that they were told they should match up to that still have very reliable and profitable business models. So it's not a one size fits all kind of situation. And the important thing to understand is, what does good look like for us based on our unique context? So with all of that, let's talk about this. Let's get into the details. There are 3 things that I want to go through with you today. The first is the metrics, the financial metrics that you should be paying attention to. So we're going to start here because this is the thing that all of you are probably doing, because you got to file your taxes each year. And if you don't do that, you go to jail. So how do you get a little bit more insight out of your finances, and how can you go do some napkin math today, even while we're doing this session, to figure out where the problem lies in your business? Then we're going to talk about the 3 margin levers. That's the meat of the session. So what are the 3 numbers that you can start using on a weekly basis to predict how profitable you're going to be before you look backwards at your finance metrics? How do you make sure that you're on track ahead of time and really start to understand not only if you're going to be profitable, but exactly where you need to focus in the business to get to where you want to go. And lastly, we're going to talk about the targets that you should be setting for all of these metrics. So this is what we're going to talk about. Couple of caveats. Everything I'm about to talk about today is simple. That does not make it easy, right? So let's not conflate these two things as being the same. Figuring out that you have a utilization problem is simple. Correcting a utilization problem, not that easy. So that's the unfortunate reality. There's a lot of things in business that are simple, but I can't make them easy. I can't make the reality easy for you, but I can give you a simple framework that you can use to get the clarity on what you need to do next. I also want to make it clear that this is a management accounting framework. And so our focus is on accuracy, not precision. Accuracy and precision are not the same thing. They're often in conflict with one another. Often the pursuit of precision actually decreases the level of accuracy in the thing that you're trying to measure. I'll give you an example of this. I can't tell you how many clients we've worked with that we go into their time tracking tool and they are trying to track at such a precise level. They're tracking every single task. They're tracking the subtask on the subtask, within the task, within the milestone, within the deliverable, within the phase. And you end up with this incredibly precise time tracking data that is very inaccurate because the level of precision that they're asking their team for is so high that compliance ends up being low. So only 40% of the time tracking data actually ends up in the system. There's no structure to the data. So the questions that they actually set out to answer with that information can't be answered because the data is so messy and so disorganized and so inconsistent. And so this conflation of increasing precision as a way to increase accuracy actually ends up working against them. So with all of that in mind, understand that these numbers they're going to be simple. They're going to be fairly broad and round, but that is by design because we are focused on increasing accuracy and not necessarily on maximizing precision, which does not help us get a more directionally accurate answer to the question that we are trying to get to in the end. And lastly, this is a management accounting framework, not a tax accounting framework. The focus here is helping you make better decisions as you run the business, not to decrease your taxable income or to make filing your taxes as efficient as possible. There are two functions in finance. Really, there's three. There's tax, there's GAAP accounting, which is mostly for reporting to external stakeholders, and there's management accounting. My focus is on management accounting, and my prerogative is to help you understand how your business is actually operating, which tax and GAAP accounting are not optimized for. And again, they're often working against your ability to understand how your business is actually functioning, especially with tax, because we're often trying to obfuscate reality to decrease the amount of money we give the government. So with all of that in mind, okay, let's talk about core financial metrics. How does an agency make money? And what should you be measuring on your profit and loss statement? There are a few things that you should be able to isolate on your profit and loss statement. The first is agency gross income. And so what is agency gross income a function of? It's revenue minus pass-through expenses. So let's define these two things, right? When you have a profit and loss statement, the first thing that you want to be able to identify is how much of my income is passing through us onto an external vendor. So for example, if you run ads on behalf of clients and you collect $10,000 a month from that client and you spend $6,000 a month on ads, your agency gross income in that case would be the 10K minus the 6K that you spend on ads, or in this case, $4,000 in agency gross income. So really what this means is there's only $4,000 out of the 10K the client's paying you that is actually yours and that you now need to earn with your team's time. So your agency gross income, or the money that you now need to earn, is what's left over after we strip out pass-through expenses. So other examples of pass-through expenses would be you need to buy stock footage. You need to hire a third-party vendor to do part of the job that you never do. So for example, maybe you build websites, you design them, but you never do the dev. So the dev partner would be a pass-through expense. This could be hard materials. This could be travel costs, right? So these are some of the things that you need to be able to isolate on your P&L so you understand what is the actual revenue of our business. And this is important because this should be the basis of your profitability analysis, and it should be the basis of your spending decisions as well. We don't want to be spending money like a $10 million business when we're actually a $4 million business, for example. So that's the first thing that you want to make sure you can clearly identify on your profit and loss statement. And most of you, when you look at your P&L, pass-through costs are going to be isolated using the cost of goods sold section in your P&L. That's not right or wrong. It's just a way of isolating it. But what that means is the thing that's called gross profit in your profit and loss statement is not actually gross profit. It's probably representative of your AGI. So just be aware of what that is, be aware that that's happening, and understand that that is not actually your gross profit. Your gross profit is going to be a function of agency gross income minus what we call delivery costs. So delivery costs are going to be the costs of doing client work. So for most of you, this is going to be a bunch of salaries, people on the team whose job is to do client work for the people that pay you. The other function here is going to be people that do some client work, but it's not their full job. So you're going to allocate a portion of their salary towards delivery. And the last piece that falls into delivery cost is what we would call shared delivery expenses. So these are, you can think about this like the tools that your team brings to the job that are not just for one client, but they need that tool to do their job across multiple clients. So for example, if you design websites, you probably have a Figma subscription, you probably have a Adobe Creative Cloud subscription, like you might have other tools that you're paying for that help your design team design websites that are not just for a single client, they're kind of spread out across multiple. So the objective here is to keep your delivery costs below 50% of AGI. So that in the middle, you have what we call a delivery margin of 50% or more. This is the objective. Essentially, what you want is for every dollar of AGI, you spend less than 50 cents to earn that dollar, so that you then have another 20 to 30% going to overhead expenses, which leaves you ideally with 20% or more for profit. Okay, so overhead expenses, this is typically going to break down into sales and marketing at 8 to 14%, admin at 8 to 14%, and facilities at 0 to 6%. If you're a remote team, you might be closer to 0. So that is typically what we expect to see on the profit and loss statement. And what's critically important here is separating delivery costs from overhead. And the two biggest accounts that are problematic here are salaries and payroll. So if all of your payroll goes to one account called payroll, that's a problem because we're not differentiating what payroll is for delivery costs and what payroll is for overhead. So we need to do salary allocations or apply classes to that payroll account in order to separate how much are we spending on delivery, how much are we spending on overhead. The second major culprit tends to be software. Often we're not differentiating between what is a shared delivery expense and what is software that's meant for, sales and marketing, admin, facilities, et cetera. Creating that separation is the first and most important thing that you could do to gain more insight into what the problems are in your business, especially if you don't have a lot of profit. Because what most people can't see is they see revenue. Sometimes they have pass-through isolated so that they can see AGI, and then they see their profit. And everything in the middle here is grouped together and called OPEX, is called overhead. And there's a black box, and it's hard to differentiate between, do we actually have an overhead spending problem, or are we just inefficient at earning our revenue? And I can tell you, after auditing hundreds of agencies, I can count on one hand the number of firms that we've looked at that truly had an overhead problem. It almost never happens. The vast majority of firms, they have a delivery cost versus AGI problem, or in other words, their delivery margin is not 50% or higher, which means no matter how efficient they are on overhead, they're just going to have trouble being profitable. The most important foundation for profitability is having a strong delivery margin. The higher this number is, the higher the percentage of each dollar that you sell to clients you get to keep, the more you can spend on overhead and still be profitable. You have optionality. You have the choice between being more or less profitable, investing more in overhead so you can grow or work less. So to me, if there's one thing that we can do to put profitability in our control, it's increasing our delivery margin. So that's the first big idea, the first big takeaway. If there's nothing else that you do today, I encourage you to go and either install a second process on top of your current monthly accounting, where you take your P&L and you transform it in such a way that you can get delivery costs and overhead. The easiest way to do that is basically applying classes to it, or make some adjustments to your bookkeeping process each month so that you can isolate delivery costs and overhead and really understand what your delivery margin is today. And that will help you get a sense of what is the real challenge in the business. And there's like a 95% chance that this is your biggest opportunity right here. So I'm going to pause there. I'm going to take a drink of water. Let me know in the chat if this is tracking. What's your biggest takeaway from this? And then we'll get into the important topic today, which is how do you improve delivery margin once you've discovered that it's an opportunity for you? All right. Are you guys ready for that? You want to know the 3 ways to improve delivery margin? There's only 3. It's really simple. All right, let's talk about it. So let's assume you run those numbers on your P&L and you figure out, okay, our delivery margin is not that great. Or even if you do figure out that our delivery margin is pretty good, but you want to make it better. You want to be more profitable and you know that this is your biggest opportunity. How do you do it? Well, there's only 3 ways to improve delivery margin. Let's first summarize the formula for delivery margin. It's agency gross income minus delivery costs. I know my handwriting is terrible. I'm aware. You don't need to tell me in the chat. I already know it. So you have to listen too. You have to listen. This is all a ploy to get you to listen. Agency gross income minus delivery cost over AGI. So if we had $1 million in agency gross income and we spent $400K to earn that agency gross income, then we would have a 60% delivery margin. Okay. So that's the formula. So at a high level, there's 2 levers we can pull. We can either decrease our delivery costs while not proportionally decreasing our agency gross income, or we can increase our agency gross income while not proportionally increasing our delivery cost. So let's talk about the 3 operations numbers that we can use to affect those 2 levers and start to create more separation between the amount of income that we generate and the amount of cost that we incur to earn that income. Okay. We're going to start first and foremost with average cost per hour. An average cost per hour is a proxy for delivery costs. Now, I'll say this about all 3 of the metrics I'm about to describe in this section. What I love about these metrics is that they're inexpensive to measure. They're very simple, but they're also able to be measured across different horizontal and vertical planes. What I mean by that is across all kinds of different time horizons, we could measure average cost per hour for a day, a week, a month, a quarter, a year, and we can measure it across all kinds of different slices of the business. So we could look at this for a person, a team, the entire business, a specific project, a specific client, right? So if you we'll look at the formula in a moment. As long as you can isolate the 2 inputs, you can look at this across all kinds of different areas of the business. And this is true about all 3 of the metrics I'm about to discuss. And this is what makes them so powerful for really diagnosing the specific areas of opportunity in the business to improve these 2 vectors, income and what it costs to earn the income. So back to average cost per hour. This is a proxy for delivery cost. Average cost per hour essentially describes what is the average cost of an hour of labor for a given area of the business. So the formula for average cost per hour is total compensation, which includes salaries, it includes benefits, 401k matching, medical benefits, all of that thing. So the total compensation for an individual or for a group of individuals divided by their total capacity, which for most people is 2,080 hours per year. And there's a project manager in the room that when I said that, they just had an aneurysm or a heart attack. And they said, Marcel, 2,080 hours a year. What about time off? What about holidays? What about vacation? We're not ignoring that. We're factoring it into the margin target. The reason we want to ignore it here is because if we're adjusting average cost per hour for those variables all the time, A, this becomes way more expensive to measure. And B, the cost basis is now fluctuating due to externalities, which means we can't actually compare project profitability from one time period to another because the basis is changing based on things that shouldn't affect project profitability. So the TLDR is, trust me on this, we've thought about this very deeply. We're not ignoring time off, holidays, vacation time. We are factoring that into the framework, but we're simplifying this metric. Again, precision and accuracy are not the same thing. So this is how we calculate average cost per hour. And the big idea here is, to the extent that we can lower the average cost per hour on different units of work, different service types, then over time we can decrease what we spend to earn the same amount of revenue. So to give you a very practical example of this, if we had a service that required 40 hours from a very senior person to complete, and that senior person costs, let's say, $150,000 per year, and we can find a way to get half of that stuff delegated to someone more junior that only costs $75,000 per year, then we are effectively going to decrease the average cost per hour on that thing by about 33%. And over time, if we have a team that we're hiring full-time roles for, as we grow the business and we take on more and more of that project type, our delivery costs will not increase proportionally, because instead of having to hire a bunch of 150K people, we can hire maybe one of those and two 75K people. And so our salaries are going to start to grow at a different rate than our income. If we have a lot of freelance labor that we use or contract labor that we use on this stuff, we're going to feel that increase in profitability or the decrease in costs much more quickly, because we have a lower latency there. We're paying for that time often on a much more frequent basis. So if we're trying to really get deliberate about lowering our delivery costs, the first function of that is saying, how do we actually get less expensive labor to do a larger portion of the work on the things that we sell? And generally, the way to do that is to create better processes, better documentation, better systems, so that the level of judgment required to complete something decreases. And generally, the less judgment is required, the less experience is required. And generally, the less experience someone has, the less expensive they're going to be. Those are generalizations, but as a high level framework, that's typically how we work through that. So that is average cost per hour. Again, just to kind of drive this example home, this strategist that's 120K, their average cost per hour is almost $60. So if I want to make, let's call it a 70% margin on their time, I would need to charge or earn $192 per hour. I'm not sure what just happened here to my screen. Okay, there we go. Conversely, this intern that costs 55K, to make the same margin on their time, I will only need to earn $88 an hour. And if I am able to average that out, so split the work between the two, you can see what that does to my average cost per hour. It lowers it quite a bit, and it also lowers the amount that I need to earn or charge to maintain the same level of margin. And of course, if I started off charging this or earning this and I decrease my average cost per hour, what's going to happen is my margin is going to increase. That is the first metric, average cost per hour. If that's insightful, if that's resonating, let me know in the chat. Do you want some free resources to help you measure and improve your profitability? If you do, then I want to tell you about our agency profitability toolkit, which you can grab absolutely free in the show notes or by heading to parakeeto.com/toolkit. It's packed with training videos, cheat sheets, templates, and all kinds of other great resources to help you start measuring and improving the essential metrics that are going to drive better profitability in your business. And it's helped thousands of other agencies around the world do the same. So I want to encourage you to go and grab a copy of that. And if you'd rather get in the fast lane and just have our team of experts guide you through the process of measuring and improving your profitability, then I want to encourage you to apply for a consultation at parakeeto.com. And with that, I want to thank you again for tuning in. I hope you enjoy the episode, and I'll let you get back to it. And we will move on to metric number 2, which is where things start to get interesting. So, this is a powerful lever, but it's my least favorite. The next 2 levers that we're going to talk about are proxies for increasing agency gross income, right? So how do we make more money without proportionally increasing our costs with the same team that we have? And so the way that we do that, the first way that we do that is we increase our average billable rate, okay? Average billable rate, some people hear that word and they think, oh, I don't bill by the hour, so I'm going to not listen to this. That is a mistake. The beautiful thing about average billable rate is it doesn't care about your billing model. You could be charging hourly, you could be selling sprints, you could be doing flat rate billing, you could be doing value-based billing, you can do projects, you can do retainers, you can do percentage of ad spend. It doesn't matter how you bill for things. Average billable rate normalizes all of those billing models and allows you to compare them apples to apples. The reason is because the formula is as follows. We take agency gross income and we divide it by what we call delivery hours. Delivery hour. So let's discuss what this means. And again, remember, you can look at this for any period of time and you can look at it for any section of the business. So I could say, what was my average billable rate per month per client or per service line or per different product that we sell, right? You can slice this however you want. And all you need to understand is what is the amount of agency gross income that we earned and what was the amount of time that got spent earning that revenue. So let's talk really quickly about delivery hours. Why did I not use the word billable hour here? The reason is I don't care if the client got billed for the time. I care if the time got spent earning the revenue. This is an important distinction to make because I'm sure we've all been in situations where we billed the client for 100 hours, but we fucked something up. The client was a little pissed off. So we spent 150 to get it done, but we only billed the client for 100. When we're measuring our average billable rate, we need to use the 150 hours because that's what it cost us to earn it. That's the delivery time that got spent doing that work. So for example, if we were trying to measure the average billable rate of different clients, this is how we would do that calculation. We have here the website build. We got paid 70 grand. We had $20,000 in pass-through expenses. So our AGI was $50,000. We spent 500 hours to get that done. $50,000 divided by 500 is $100 per hour. So for every hour that we spent working on this website, we moved $100 from our balance sheet to our profit and loss statement. We earned $100 worth of value. Next, we have the brand design. So here, similarly, we had 20 grand. We spent 5,000 on pass-through, which means we made 15 in AGI. We spent 100 hours to do this, so we earned $150 per hour. And lastly, the sleeper, the funnel build, we got paid $30,000. We gave most of that away to a third party, but the 10 grand that was left over, we barely spent any time earning it. We made $200 for every hour that we spent there. And on average, we made $115 an hour. The reason this $115 an hour is lower than you would expect is because the weight of the website build is larger, right? It's a larger proportion of our revenue. It's a larger proportion of our time. So this is really important because without this information over here, or this information, if I asked 10 clients, what is your most profitable project? Almost all of them would say the website because the income number is the biggest. But when we really pay attention to efficiency, how efficiently do we earn this money? We start to see that actually the website build is the least profitable thing that we do. And importantly, if we were able to spend all 500 of these hours here, if we were able to do 10 funnel builds and replace this one website build, we would almost double the amount of money that this business made with the same team size, the same number of hours invested. Nothing else about the business changes, but our income would double. It sounds too simple to be true, but it really is that simple. So that is average billable rate. And the important thing I want to drive home here is this is not just about pricing increases. Yes, you can increase your price, and that is a very quick and effective way to improve your average billable rate. But the other way to do it that is just as powerful is you find more efficient ways to do things. You spend less time to earn the same amount of revenue. They have the same impact on average billable rate. Now, Justine asked a question, how do we figure out our target average billable rate? Well, the way that we would do that is we would take our average cost per hour and we would divide it by 1 minus our margin target. And I generally encourage you to start with a 70% margin target. So in this case, let's say my average cost per hour was $30 an hour. I would divide that by 0.3 if I wanted a 70% margin. And I was told to never do math live on a call, but I'm breaking that rule right now. 30 divided by 0.3 is $100 an hour. So this would be the minimum average billable rate that I would need to charge to make a 70% margin if my average cost per hour is $30 an hour. So hopefully that's helpful, Justine, in terms of figuring out what is the floor for my average billable rate. Okay. Here's another little hack for you. I call this Kirkland brand delivery margin. If you're trying to get a sense of what was my delivery margin on a given service, client, project, whatever, as long as you can measure your average billable rate and your average cost per hour, you can figure out your delivery margin on that thing by just swapping those into the margin formula. So for example, if I had a $100 average billable rate and my average cost per hour was $30 on a project, then my delivery margin on that project was 70%. Okay, so again, without having to go through finance, without having to wait a month for your finance data to be reconciled, as long as you can figure out these two simple numbers that only need an understanding of what you got paid and how much time went in, you can start to get an accurate sense of how profitable different areas of the business are and really get focused in on where are we making the most money. So we've talked about average cost per hour. We've talked about average billable rate. There's one more metric that we can use to control our destiny and take control of our delivery margin. And that is utilization. Utilization. It is the, as I like to say, the dark saber of agency metrics for all my Star Wars nerds that are in the room. It has great power, but it requires great responsibility, and it can do great damage if we don't use it properly. in particular, if we start holding our team accountable to an arbitrary utilization target, that will probably make us less profitable. And I'll explain why in a moment. Okay, so utilization. What does utilization do? Well, again, it's a proxy for agency gross income. What this essentially is measuring is the portion of the time that we buy from our team that is used to earn our average billable rate. What percentage of the time that we buy from our team is used to earn revenue? So the formula for utilization is the number of delivery hours that got worked, not billable hours, right? Again, I don't care if we build the client for the time. I care that the time got spent doing client work, not building the company website, not updating the company's social media, not building SOPs and processes internally, not sitting in internal meetings, not filling out the timesheets, not sitting at the company offsite. All of those things are productive, yes, but they don't earn revenue directly for the business. So only client work ends up here, and it's all the client work ends up here. And we divide that by total capacity. The same way that we calculated it for average cost per hour, which is all of the time that somebody has available, and we ignore vacations, holidays, sick time, time off, unbillable time, internal time. So for most people, again, 2,080 hours per year. And again, we're not ignoring those things. We need to leave them in capacity because we need to see the cost of those things in terms of how they affect our utilization. If we start to decrease someone's capacity by removing holidays, time off, internal time, non-billable time, then by definition in this metric, the more time off people get, the more holidays, the more internal stuff they work on, the higher our utilization rate will be because the basis is getting smaller. That's the opposite of the truth. So we cannot measure this metric this way. And why people do that is a whole other discussion. But most of the time it's because they're trying to hold their team accountable to utilization. And then the team starts to feel that it's unfair that their utilization goes down every time they take time off or they work on internal projects. And the fundamental problem there is you shouldn't be trying to hold your team accountable to a utilization target because it's not their responsibility to be utilized. It's your responsibility to have the right amount of staff and the right amount of work so everyone is busy. This is a management metric, not an individual metric. And Beth, to answer your question, when I say delivery hours, it's not the same as a billable hour because I don't care if the client got billed for the time. Again, this is all the time that got spent doing work for clients, regardless of how it affected what the client paid us. So all of the time spent doing work for clients, regardless of how it affected the client's billing situation. And in some businesses, and a lot of businesses, these two metrics are different. We might bill the client for 100 hours, but we might have actually spent 125 doing the work. We care about the 125. That's the number we use here. And it's also the number we use back here to measure average billable rate. And the reason that that's important is because if we don't do that, if we did these based on billable hours and we spent more time than expected on a project, our average billable rate would look fine and our utilization would look low. So the insight would be, oh, we're not busy enough. But again, that's actually not the truth. The truth is we were plenty busy. We were more busy than we expected, but we were not as efficient as we thought we were going to be earning the revenue. And so in order for that reality to be reflected, we need to use delivery hours, both in utilization and in average billable rate, and they need to be consistent together. You could tell I spend way too much time thinking about this stuff, I'm sure. Okay, let's talk about utilization. If your utilization rate is low, how do you fix it? Right, so let's look at this situation. We have a certain amount of capacity, we have a certain number of delivery hours, and we have a target for utilization that is set here. And we have a gap, right? We're not gonna hit that utilization target. There are only two ways that we can fix this. So this is a pop quiz. Let me know in the chat. What are the two things that I can do in this situation to close this gap and hit my target? Remember, I have two levers. I have capacity, I have delivery hours. What do we do here to improve utilization? I'm gonna take a drink while I wait. It's very important to stay hydrated, by the way, everyone. And if anyone has a connection to BioSteel, I would love a sponsorship from BioSteel. I drink copious amounts of it. Reduce staff. That is the correct first answer, right? I'm going to call that reduce capacity because I've had corporate PR training. But yeah, that's just robot corporate speak for lay people off. So reducing staff, Harjot, is the correct answer. And Jamina has the other correct answer. So gold stars to both of these people in the chat. Sell more work. And you used exactly the right language, which I'm so happy about, which is sell more work. I've seen a lot of people that they see a low utilization rate inside their agency. And so they go to their team and they're like, team, I need you to get your utilization rate up. I need you to work more hours. And so what does the team do? They spend more time doing the same shit they were doing before because we haven't actually sold any more work. So what happens when they do that? Well, their utilization rate will go up because delivery hours increase, but average billable rate will go down. And you know what won't change? Delivery margin. It'll stay exactly the same. So the business is actually in a worse position when that happens because now the team is busier. They feel busier. They're more stressed. Clients have a different expectation now of what's reasonable in terms of the level of service, and our profitability hasn't improved. So that is not the right thing to do. Do not go to your team and say, hey, you need to hit this utilization target, because that's what's going to happen. They're going to spend more time doing the same things they were doing before. It's going to obfuscate your understanding of how long things actually take. So your time tracking data becomes actually less accurate, less truthful, and you have no improvement in profitability. So do not do that. The only way that you can improve your utilization is to reduce capacity, adjust your staff so that it's at the right level for the work that you have coming in, or using that exact language that Jamina articulated in the chat, sell more work, more revenue that can be earned with that additional time. So that concludes the three levers, and I want to put them together in an example here, but just to drive this point home, here's an example of a utilization rate formula that you could run to, for example, measure how utilized somebody was within the month and look at the utilization of an entire team. So we have all of their capacity, we have the number of hours they spent doing client work. That tells you what percentage of their time was utilized to earn revenue. And again, you sum those things up and you get a sense of how the business was utilized. And in terms of what those targets should look like, take a screenshot of this or reach out to Chris and I can share these slides afterwards. Generally on a weekly basis, pure producers, so this is designers, developers, copywriters, like people who their whole job is just to come in and get things done for clients. Generally, we expect them to be at 75% plus per week. You want to take anywhere from 10 to 20% off of that target on an annual basis to account for time off, holidays, sick days, internal stuff, etc. Delivery managers, these are your project managers, account managers, heads of design, head of development, creative directors, right? So they spend a lot more of their time actually coaching the delivery team as opposed to doing work directly for clients or managing across all of the different things that are going on. You can generally expect them to have a much lower utilization rate. And anybody else, owners, salespeople, assistants, etc., anything above zero is gravy. And as an agency, I know this is going to sound crazy, but it's really true. We've looked at hundreds of agencies. Very few of them are outside of these bounds. You want to try to have a team composition that allows you to get to 50% or more utilization. The high end is 60, 65 on an annual basis, and on a weekly basis, about 65%. Julia, why only 75 for production? I mean, again, 75% plus. So we do see some production team members that are much higher than that, but 75% of 40 is what? 32 hours? 40 multiplied by 0.75. Again, yeah, 30 hours. So you have to account for internal time. They might have one-on-ones with their manager. They might have, other work to do in the business, filling out timesheets, breaks, those kinds of things. So, some people have more responsibilities to that end. Some people have less. We have seen producers that have very low client dilution be at 34, 36, 38 delivery hours per week. Like for example, if I'm a software developer and I work on the same project every single week for months on end, and I don't really have a whole lot of other things to worry about, I could be very, very utilized and not feel that stressed. Whereas if I am a designer and I'm working on 8 different projects at a time, my utilization rate is probably going to actually be a lot lower because the amount of context switching that I have to do, the amount of internal meetings I have to do is much higher. And so keep in mind that dilution across many different clients typically lowers the maximal utilization rate of an individual employee. And you have to consider what other responsibilities, meetings, other kind of work they need to be doing internally that they're accountable for. So again, it's not that 75 is the target, 75 plus is what we would typically expect. So 30 is kind of the floor. If you can get to 32, 34, 36, that's even better. What was the top end of the yearly? Yeah, top end is about 65%, Justine. Like we typically don't see a lot of agencies that are structured in such a way where their maximal utilization after pulling out all the time off, et cetera, across the whole organization is above 65%. And keep in mind, this is everybody in the business. It includes people that are 0% billable, like owners and salespeople and admin. We, again, want to include all of them in this calculation so we can see the cost of all of that in terms of how it affects our utilization rate. Yes, Kyle, good point. Okay, let's go through an example. I want to drive all this home and then we'll open it up for some questions. Let's imagine we have this agency. They have a capacity of 100,000 hours a year. So about 50 people on their team, give or take. They spend $3 million on their delivery costs. So that's delivery salaries and some shared delivery expenses. And then their overhead is another $1.5 million a year. So that's, again, overhead expenses and salaries. So in the first situation, this organization has a 50% utilization rate, and they have an average billable rate of $100 an hour, which means for every hour that they spend doing client work, they earn on average $100. So in this first example, their agency gross income is 50% of 100,000 hours or 50,000 hours multiplied by $100 per hour. So $5 million. Okay. Their delivery margin is 5 million minus 3 million, or in this case, $2 million, which is about 40%. And their net profit is that $2 million minus the 1.5 that they spent on overhead. So in this case, 500K, or 10% of their agency gross income. So that's scenario one. This is pretty standard, honestly. Like most of the firms that we see, they end up at about 10% after we adjust for founder compensation and those kinds of things. So this is about an average outcome. But this firm is not happy with this. They want more profitability. I'll tell you what, if I made all the sacrifices required to build a $5 million a year agency, I would also want to make more than 500K on the bottom line. So the first thing they do is they say, hey, you know what? We're going to increase our utilization rate. We're going to get a little bit more deliberate about resource planning and forecasting. We're going to get a little bit tighter on hiring and training. And we're going to decrease some of the internal overhead that our team has to deal with so they can spend more time on client work. And as a result, they go from 50 to 60%. So in this example, without changing anything about their average billable rate, they can now earn $6 million with that same team, which means their delivery margin goes from $2 to $3 million or 50%. And assuming nothing else changes about the business, they still spend 1.5 on overhead. Their profit margin is now what? Pop quiz? $1.5 million or 25%. So that's pretty sweet, pretty exciting. In the last example, they maintain their utilization rate, but they're able to increase their average billable rate. Maybe they make a few pricing tweaks. Maybe they find some ways to get a little bit more efficient at getting things done and decreasing the amount of time that it takes them. And in this example, they now go to $7.5 million in agency gross income that they can earn with this team, which would be a $4.5 million delivery margin or 60%. And that leaves them with a $3 million profit or a 40% EBITDA. We haven't even talked about decreasing overhead. We haven't even talked about decreasing their average cost per hour and lowering their delivery cost. We've literally only talked about two numbers, okay? Utilization and average billable rate. Just with those two levers, we went from $500 to $3 million in profit, 10 to 40% EBITDA. And if you think about what this does to the value of this business, let's imagine here they were worth 4 times EBITDA. So maybe a $2 million business. In this last example, they're probably worth closer to 5 or 6 times EBITDA. So we're talking about $15 to $18 million valuation. That's like a 500% increase in the value of this company. And all we did was make the existing business more efficient, the existing team a little bit more efficient. Nothing else changed. We didn't hire people. We didn't change our overhead spending. We just got more efficient at earning revenue using 2 levers. So that is the power that these simple numbers has on the business And what's beautiful about them is they don't require you to rely on your finance department, on your bookkeeping. You can start to measure these numbers much more quickly, much less expensively, using the data that flows through your business every day, such as time tracking data and just some simple information that you can pull from client contracts. So that is my gospel that I'm trying to spread, and I hope that it's helpful. All right, that's all for the presentation. I want to remind you that there are a bunch of tools to help you actually install and measure the metrics that I just talked about in this presentation in our agency profitability toolkit, which is absolutely free and available to you in the show notes of this episode. So do go check that out if you want to start installing some of these things in your agency and seeing how these numbers play out for you. With that, I want to thank you again for tuning in to the show. I hope you enjoyed it, and I'll see you on the next episode. Hey, thanks so much for tuning in to today's episode. I hope you enjoyed it. And if you've ever found yourself thinking, man, I get so much value from this podcast, I wish there was something I could do to return the favor. Well, today's your lucky day because you can leave us a review wherever you're listening to this, and it is incredibly helpful. Of course, if you haven't grabbed a free copy of the Agency Profit Toolkit, go and get that. It's got tons of free resources to help you improve your profitability. If you're looking to get in the fast lane and get help from experts to improve your profitability and measure your most important metrics, then apply for a consultation at Parakeeto.com. We'd love to chat with you and figure out how we can help. With all of that, thank you so much for being a listener, and we will see you on the next episode.